Picture this. It's 2026. The financial world is collapsing. Banks are failing. Millionaires are losing everything overnight. But while everyone else is panicking, a small group of people are doing something different. They're buying. Aggressively. Warren Buffett invested $5 billion into Goldman Sachs. Mark Cuban was scooping up real estate. Why? Because they understood something most people don't. Wealth isn't built by following the crowd. It's built by thinking differently about money itself. Here's the truth that nobody wants to tell you. The 1% aren't smarter than you. They don't have some secret gene that makes them better with money. What they have is a different operating system, a different set of rules they follow religiously. And today, I'm going to show you exactly what those rules are. Because here's what I've discovered after studying hundreds of wealthy individuals. The difference between staying broke and building real wealth isn't about how much you make. It's about how you think. And in the next 9 minutes, I'm going to reprogram the way you see money forever. The first thing you need to understand is that the wealthy don't work for money. They make money work for them. I know you've heard this before, but let me show you what this actually means. When you get paid, what's your first thought? For most people, it's what can I buy, or what bills do I need to pay? But the 1% ask a completely different question. How can I make this money multiply? Let me give you a real example. Sarah, a teacher making $50,000 a year, was living paycheck to paycheck. She thought she just didn't make enough. But here's what changed everything for her. She started treating her paycheck like a business owner treats revenue. Instead of seeing $50,000 as money to spend, she saw it as capital to deploy. She took $200 from her first paycheck and bought a dividend-paying stock. Small, right? But here's the key. She made that automatic. Every single month, without thinking about it. 5 years later, that portfolio was generating $400 a month in passive income. That's $4,800 a year she didn't have to work for. And it's still growing. This is the first rule of the 1%. Pay yourself first, but not in the way you think. You're not saving for a rainy day. You're investing in your money-making machine. Here's where most people get it completely wrong. They think assets are things you own. Your car, your house, your furniture. But the 1% define assets differently. An asset is something that puts money in your pocket. A liability is something that takes money out. By this definition, your $40,000 car? That's a liability. It's costing you insurance, gas, maintenance, and depreciation. Your primary home? For most people, that's a liability too. Property taxes, maintenance, mortgage interest, it's all money flowing out. Real estate investor Grant Cardone put it this way. The middle class buys liabilities and thinks they're assets. The wealthy buy assets and let them pay for their liabilities. So what are real assets? Stocks that pay dividends. Rental properties that generate cash flow. A business that runs without you. A skill that people pay for. Intellectual property that earns royalties. Here's your action step. Open your banking app right now. Look at your last 3 months of expenses. Circle everything that puts money back in your pocket. That's your asset column. Now circle everything that only takes money out. That's your liability column. The 1% have a simple rule. Never buy a liability until your assets can pay for it. Want a luxury car? Fine. But first, build investments that generate enough passive income to cover the payment. This one shift will change everything. Most people think about money like a battery. You charge it up, then you drain it, then you charge it again. But the wealthy think about money like a river. It needs to keep flowing to create power. Let me explain with a story. Real estate mogul Robert Kiyosaki teaches something called the velocity of money. Here's how it works. Instead of letting money sit idle, you make it work multiple times. Example, the 1% use something called equity recycling. They buy a rental property. It appreciates. They refinance, pull out the equity tax-free, and use that money to buy another property. Now they own 2 appreciating assets, generating 2 streams of cash flow, with the original investment doing double duty. Compare that to someone who saves $50,000 in a savings account earning 0.5% interest. That money is essentially dead. It's working once, slowly, making maybe $250 a year. But watch what happens when you increase the velocity. Take that same $50,000. Put 20% down on a $250,000 rental property. Cash flow, $500 per month. That's $6,000 per year, a 12% return. The property appreciates 4% annually. That's $10,000 in equity on a $50,000 investment, another 20% return. Now you're looking at a 32% total return versus 0.5%. And that's conservative. The principle is simple. Make every dollar work as hard as possible, in as many ways as possible. The 1% are obsessed with this. Here's something that's going to blow your mind. The tax code is written by the wealthy for the wealthy, not to exploit you, but to incentivize behaviors the government wants. The government wants people to provide housing, so they give tax breaks to real estate investors. They want business creation, so they give deductions to entrepreneurs. They want investment in the economy, so capital gains are taxed lower than ordinary income. W-2 employees, people who trade time for money, get taxed first, then they spend what's left. But business owners and investors spend first, then get taxed on what's left. That's a massive difference. Real example, a corporate employee making $100,000 pays taxes first. After federal, state, and FICA taxes, they might take home $70,000. But a business owner with $100,000 in revenue can deduct their home office, their vehicle, business meals, equipment, education, travel, and dozens of other expenses. They might only have $60,000 in taxable income. They're spending the same amount, but one person is paying taxes on $100,000 while the other pays taxes on $60,000. I'm not saying quit your job tomorrow, but I am saying this. The 1% structure their lives to take advantage of the legal tax incentives available. They have LLCs, S-Corp, self-directed IRAs, and other vehicles that most people never explore. Your action step: talk to a CPA who works with high net worth individuals, not H&R Block. Find someone who understands tax strategy. This one conversation could save you tens of thousands over your lifetime. Here's a hard truth. Your network is your net worth. The 1% understand that who you know matters just as much as what you know. Think about it. If you're the smartest person in your friend group, you're in the wrong friend group. Not because you should look down on them, but because growth happens at the edge of your comfort zone, around people who challenge you. Tech investor Naval Ravikant says, surround yourself with people who are where you want to be, not where you are. The wealthy do this intentionally. They join masterminds. They pay for high-level coaching. They attend conferences not for the content, but for the conversations in the hallway. Why? Because one introduction, one partnership, one idea from the right person can be worth millions. I've seen this personally. A friend of mine was stuck at $80,000 a year. He joined a $10,000 a year mastermind for entrepreneurs. Seemed crazy, right? But within 6 months, he met a partner who helped him scale his business to $500,000 in revenue. That expensive investment returned 50x in year one. You don't need to spend $10,000, but you do need to be strategic. Attend local real estate meetups. Join online communities in your field. Find a mentor. Offer value to people ahead of you. The 1% are generous with their knowledge when you approach them with genuine curiosity and respect. Your network isn't just about making money. It's about access to opportunities, information, and perspectives that aren't available anywhere else. Here's the ultimate difference between the 1% and everyone else. They're willing to live like no one else today, so they can live like no one else tomorrow. But here's the twist. It's not about deprivation. It's about prioritization. The wealthy still enjoy life. They travel. They drive nice cars. They eat at great restaurants. But they do it on their terms, funded by assets, not at the expense of their future. There's a concept called lifestyle creep. As most people earn more, they spend more proportionally. They get a raise and immediately upgrade their apartment, their car, their wardrobe. They stay on the same hamster wheel, just with nicer scenery. The 1% do the opposite. They increase their income and invest the difference. They live below their means during the accumulation phase. Not forever, but long enough to build the machine that generates wealth without them. Warren Buffett still lives in the house he bought in 1958 for $31,500. Not because he's cheap, but because he understands that every dollar not spent on impressing others is a dollar that can compound into real wealth. So here's my challenge to you. For the next 90 days, live on 80% of your income. Take the other 20% and invest it like the 1% do. Not in crypto get-rich-quick schemes, not in risky day trading, but in solid, boring, wealth-building assets. Index funds, dividend stocks, a side business, real estate crowdfunding if you can't afford property yet. Track what happens, not just to your bank account, but to your mindset. Because here's what you'll discover. The 1% aren't lucky. They're not special. They just play a different game with different rules. And now, you know the rules too. The question is, are you going to play? If this changed how you think about money, do me a favor. Hit that like button, subscribe for more financial truth bombs, and drop a comment telling me which rule you're implementing first. Let's build wealth together. Now go out there and manage your money like you're already part of the 1%. Because with these principles, you're already on your way.